Hi, welcome to Market Update for September 13th. Well, as the market settles in on these new all-time highs, and we've really got the all-time highs across all of the industries, one of the things that we want to pay attention to and focus on is the quadruple expiration this Friday. Now, aside from of course, the options and futures on options and futures themselves, and of course, single stock futures expiring, there is also a crude oil expiration. Now, I bring that up because remember, this is a market now that has been very, very tied to inflationary pressures or disinflationary pressures, really portrayed in what the action is in the currency market. So if you pay attention to the dollar over the course of, say, the last 8 months, and you overlay an S&P market chart on top of that, you'll notice something that's very, very strange. As the dollar goes down, the S&P goes up. So what we want to see is the market actually correct that action. Now, going into this expiration, we're probably going to get a feel for how the market had been positioned prior to this next 2 or 3 months. Chances are that a lot of the buying that we've been seeing has been short covering as professionals have been really fighting this market over the course of the last couple of months. But going into the last quarter of the year, let's pay attention to the currency market, in particular the dollar against the euro. Remember, we're looking at profitability and overseas profitability in particular that's going to be affected by the movement of the currency. If the dollar continues to go lower, it might be weaker for us in the long run, but it will show corporate profitability. On the other hand, if we start to see the dollar strengthen, which is something for the long term we would like to see, it's probably going to hurt corporate profitability. So keep that in mind as we start to see the action unfold over the course of these next couple of months. Other than that, pay attention to the interest rates. Remember what we've seen, a huge move as we saw the low yield of the year in the 10-year down around that 203 level and now spike right back up into the 217 to 220 level. So if that market were to break out, it also could be sending a very, very important message as far as what the Fed might be doing later on this year. This is Jack Barugian from the CME Group in Chicago.